I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for March 16th, 2020. We've opened up the Macro Show today. We think people obviously need some help in this, so welcome to all the new viewers. I'm going to hand it off to Keith so we can jump right into it.
Thank you, DJ. Top three things in my notebook is what I go with every morning at the top of the risk management morning. Today's no different than any other morning. I understand that you might say so. It's differently in terms of people's emotion or people's reaction to what I would have said you should have proactively prepared for. Don't forget that the stock market had 4 separate rallies that you could have sold into and or you could have bought treasuries all the way back to when this started pre-virus. So again, what could have possibly gone wrong? Earnings went to 0% growth pre-virus. U.S. growth is slowing to the low of the cycle pre-virus. All this stuff was happening. So again, I feel bad. I actually genuinely do feel really bad for people that have had to watch the old wall and all of its conflicts of interest and all of its media just basically take you to where you were the last 2 times that I saw signals that the stock market was about to crash back in 2008 and back in 2001. So let's just get into it. Top 3 things this morning in my notebook. We do this every morning. Number 1, going to do volatility of the U.S. equity market, which matters a lot more than the simple moving average of the price, don't forget. Point number 2, just talk about actually the biggest risk this morning that we need to talk about is the bond market and gold, which we highlighted on the Macro Show on Friday. Again, not new this morning, but it'll be a friendly reminder there. And then finally, just to hit on levels in terms of where we could and should go next on SPYs. So first, on volatility. So Friday, I couldn't make this up if I tried, but Friday, Genron, if you throw up where implied vol went, it went to a 15% discount versus what's been realized in the last 30 days. Now, some of you are going to look at that and say, what the hell is that? Well, the reality is we know what that means as people of the Hedgeye process. So again, that means that people were too complacent and or capitulating on the short side. So when you get an implied volatility discount, what that means is versus the prior 30 days, people were not really willing to buy protection at a premium to that. So again, they traded at a discount. So that's precisely what you should have done on Friday. It was a bloody gift to short risk across the place. We shorted financials, technology stocks. We're still short junk bonds. There's plenty to do there. But again, that's one of the screaming signals there. The other big thing is that I have front month VIX going up to top end of the range is in the mid 70s, 74.85 on the VIX. So again, this is, I tried to help you guys with this, but again, a breakout or what we call a phase transition in fractal math above 31 on the VIX was a danger signal that made all of equity uninvestable, all of it, including utilities, gold miners, all that stuff. So again, there comes a point in vol space or volatility space where human beings just can't handle the truth. So the reality is that this move is unprecedented going back to 1987. We said that that's exactly what it looked like, and now it might look worse. So again, volatility on the high end, top end of the risk range, which we also publish in our daily risk range product. For those of you that don't know what that is, you can look that up. 74.85 is the top end of the range for the VIX. Point number 2 this morning is the 10-year yield. Okay, now, if you didn't know, now you know. The volatility index for the Treasury market is called the MOVE index. The MOVE is moving. The MOVE is moving out. See where we're at, 2020? That is not Pluto. That is indeed where we're at here in America today. Again, so what you see on the X and Y axis here is Treasury bond vol against high yield spreads. Again, I really feel bad for people that don't know what the hell these things are, but I don't have time to explain it all this morning. These are some of the most basic things in risk management, and it's a real shit show this morning if you want to get technical. Okay, so that's a problem, a big problem. This is what happens. The MOVE moves, or Treasury bond vol moves, when the market's already priced in that the Fed has to go dovish, and then bond yields bounce because it was priced in. Then people say, wow, I don't know where the bond yield can go. They're cutting rates, but yields are going up. This is what happened in Australia last week. The Australians had a panic rate cut, and there was a 30 basis point up move in the 10-year yield in Australia back to almost 1% on that. So again, this is what happens when the Fed is pushing on a string. They don't know how to control it. And again, they can't put people back to work. Unfortunately, this is a very big problem economically, and I'm certainly not talking about that. I'm trying to help you and your wealth. Again, the only thing worse than having a problem here endemically for both your families and everything else broadly, which again, I have a tremendous amount of empathy for that, is losing your money. Now, you don't want to do that, okay? We need liquidity. We need to have risk managed this properly. And when the MOVE moves out like that with high yield spreads, 700 over and rising, there's absolutely no catalyst for stocks to go up. Point number 3 this morning is SPY. So if all you do is look at stocks, again, apologies in advance for whoever the hell taught you that. That's not the market. It's part of the market, right? There's a currency market, rates market, commodities market. I don't want to insult people's intelligence. It is insulting that other people do that all day long on Old Wild TV or CNBC. What a joke. Now Cramer's going to try to get the stock market closed. Go home, buddy. The reality is that what we need to do here is look at the right levels that are, again, inverse to the volatility outlook that I have. So at 74.85 on the VIX, I have 22.83 on SPYs. Okay, on the way there, if we get to 65 vol, I'm at 24.11 on the S&P 500. So that's how I stair step down. I have a model that is the volatility of volatility, again, that is front running the price. So again, if you're just looking at the surface area of the price, you got a lot to learn. It's about price, volume, volatility. Okay, on Friday, what did the volume do in the market on the up move? It was down. Okay, this is again consistent with what's been happening on all 4 rallies that you saw in the U.S. stock market. I think 4 up days in the last 17 or 18 days. Volume had been down versus the prior day. So again, if you haven't measured and mapped it this way, if you don't have the code for my algo, that's fine. I'm telling you what mine says, and I'm telling you what to do with that. All right, those are your top 3 things. Now we get into, again, if this wasn't what you were doing yesterday, again, don't look at my fat face. Look at this. Okay, this is what I was doing yesterday. Okay. Zoom into that. This is, write it down. Every freaking risk range that's out there, deliberately study where the market is. I've been doing this for 22 years and I'm going to do it, God willing, for some more. Again, you have to deliberately study the market. If you're waking up in the morning as a macro tourist, you're jumping from headline to headline, you have emotions, it's all visceral, you're doing it wrong. If you're looking for a monkey to tell you what to do with his moving averages, you're doing it wrong. If you're looking for a circus clown to tell you what to do with some stock, that you're doing it wrong. What you need to do is, again, study the system. This is a nonlinear ecosystem, just like anything else in nature. And it's gone all fractal on the permabulls. Okay, here we go. Just to get through these things, what I'm just going to do is give you some of the things that are in my notebook to help you that are already writing it down in your notebooks. And again, I think that it's an important thing for you to do. Study, for you to actually understand what's going on, you have to study it deliberately and daily. And if you don't have time for that, I understand. I'll do it for you with my 40-person research team. All right, S&P 500 risk range is 24.11. Okay, so that would be the minus 11.1%. So it's kind of interesting. Jonesy was saying, hey, look, you know, they're going to limit down SPYs is basically 7%. Then you get your 3rd adult timeout for permabulls today. But SPYs are trading below that, right? Yeah. Like, I don't know, where are they trading right now?
Yeah, the SPY ETF was down about 10%, so that's a better indication of where they'll eventually open, right?
Right. Okay, so that's what that would be pretty much in line. Like Australia last night was down 9.5%. You know, Thailand was down 7.4%. People are like, what about this? Can you talk to me about my stock? No, countries are more important to the interconnected ecosystem than your favorite stock. Just newsflash on that. So again, all that we want to be paying attention to is what is the probable outcome today. So again, on Friday, I could have told you, and what we told our subscribers was that there's 11.1% downside versus Friday's close. That's probable. That's not like possible. There's a difference. Probable and possible are 2 different things. It is possible that somebody delivers a ton of gold right to the front of Hedgeye's door today because they're happy with what we've done. But it's also, that's possible, but it's probable that I give that back because I'm selling gold right now. Okay, so again, think about possibilities versus probabilities, okay? Top end of the range, again, I get like 0.7% upside, so I got 27.32. Again, these are written down daily. I don't nail it daily. Every single day I don't nail the range, but I get pretty damn close. And versus the alternative, which is nothing out there, I think that's a pretty damn good thing to have for $30 a month, which is a risk range product, if I don't say so myself. And by the way, that's why I built it. I want to help you. I want to help you against that old wall. They've been screwing you for so long, and yeah, it pisses me off. All right, 2732, 0.7%. Okay, that's how much upside you had. So again, even if you're like the worst gambler on the earth and you do trade stocks as some kind of like a educated version of gambling, you had no upside to buy stocks on Friday. You had 0.7% upside, 11.1% on the downside. What could possibly go wrong? Okay, look at the sectors on the bongo board, guys. What happened on Friday? I mean, the biggest short selling opportunities in a developing bear market, and one certainly that's crashing, is to short the stuff that's up the most. So tag 1, 2. What did I short on Friday? What's up the most there in the 1 day column, guys? You guys can get good at this. Financials and technology. So that's where I would go if you're not short or short enough today. Right on the open, no matter what the stock market's down, I would short those. Yeah. I'd short them right on the open if I wasn't already. And you don't have to. That's certainly not the good move to make relative to what you could have done on Friday or the 3 up days before that in the last month. Okay, so there's plenty of opportunity there on the short side. Financials, again, big problems. Don't forget, financials are part of why earnings weren't down more in the fourth quarter pre-virus. Post-virus, most financials are probably going to withdraw their guidance. Some of our favorite shorts, Jonesy can walk through those with you. He's our director of research. We shorted a couple on Friday, actually. PayPal, Discover, Synchrony Financial, Amex. These companies are going to see credit problems at the consumer level because the consumer's in what?
Duress.
Yeah. But Wall Street came into this and the consumer's in great shape. No. Actually, that's a lie. The consumer was in slowing shape. Great means nothing in rate of change terms. So if you're not mathematically oriented, you're going to get mathematically oriented with me. And if you don't like it, I'm going to coach you that way anyway. Okay? Rate of change is something accelerating or decelerating. The rate of change of consumption growth and GDP growth were slowing pre-virus. Now they're just doing what? They're slowing at a faster rate. So again, that's when the credit quality issues start to percolate, not only at the corporate level, but in this case, at the consumer level. That's why we're short the credit card companies. What else we got going on for you this morning? I already hit on pretty much everything I want to hit on in the USA. Japan, so again, you got to do your work. It's not just about stocks, in whatever, Kramer speak, or whatever, some unreformed broker. Again, don't listen to your broker. I'd listen to your broker if they subscribe to Hedgeye, but I certainly would be talking to some guy, running around, talking about stocks. I mean, this is no time for unreformed men, okay? Let's get into this. So again, Japan was the first country to go to the cowbell. 500 billion yen, and then they did it twice, and they bought stocks, and stocks still crashed. So what do you think the Fed can actually do other than Kramer getting on his knees and begging for the market to be closed? And then it's going to crash even faster. If you want to go back, and if there are any questions on that, if you haven't studied history, go back to when we've closed U.S. banks and or closed the stock market and tell me what happened when they reopened them. People, people get shit scared of this stuff. They want to get their money out as soon as they can because you closed it because you're lying to them. Don't forget that this is the government doing these things. Not all Americans at this juncture fully and wholly believe their government. What else do we got going on for you this morning away from Japan being down 28% in a month? Already talked about Thailand. That's down 7.4% overnight. India down 7%. Australia down 9.5%. Again, if you haven't done your work this morning, you don't know that. If you haven't been doing your work on Asia since the Q1 of 2018, cue the Hong Kong, all right? The Hang Seng is down. Again, that's down, what is that down? 31%? We went bearish on China, Europe, and emerging markets where that chart starts, okay? So when people tell you nobody could see this coming, just change that and say, no, you didn't, okay? Now, the global slowdown started in Q1 of 2018. The US peaked and started slowing at the end of Q3 of 2018. Write that down. That's not an opinion. Those are economic rate of change facts. Okay, so that's what's going on there. Look at the DAX. Do we have a chart of the DAX here, guys, this morning? Yeah, that looks pretty similar, doesn't it? Straight down. The DAX, which we were long in January, we told subscribers, hey, look, this virus is going to make Germany go back to what we call Quad 4. So if you go to slide 20, guys, in the G20 Playbook, the only ones that were really left in the world's economy, because we already had China and the USA going to Quad 4 in Q2 of this year, pre-virus, were the greens in that Q2 column were the European ones. Those are going to go to red. So this is going to be, in terms of the quads, Quad 4 is when you have what? You have both growth and inflation slowing at the same time. This is why I'm quite surprised that Ray Dalio got this wrong. Been a long-standing, almost an idol of mine, again, because he really has somewhat of the same framework. If you go to slide 6, you can see what our framework is. It's called the 4-quadrant map. So when you have growth and inflation slowing at the same time, you're in Quad 4. Okay, so Quad 4 is bad. Most of our institutional clients, we advise over $1 trillion in assets under management, obviously pay attention to that, because when Quad 4 happens, shit hits the fan, okay? So generally speaking, treasuries work there, gold works there, but not to the point where they start to pick up some volatility. This morning, for example, gold's volatility has broken out. That's GVZ again. These are some really basic stuff. For me, it's like, I was an average at best hockey player, but it's like putting on your skates in the morning, knowing where the volatility index is. Gold volatility this morning shot to almost 40. Okay, so that makes gold uninvestable for now. And again, for long-term bulls on gold, we bought gold all the way back in Q4 of 2018. Yeah, you could buy it at tail support, but that's all the way down. That's all the way down at $1,400.58. And I'm not quite sure I'd buy it there either. So again, important to be paying attention to all this. Oil still in crash mode, low end of the risk range. Again, that's in your risk range product now below 25. So 24.73. You talk about volatility. Oil actually has 100, and it's almost like a typo in my own notebook, but it's not. Like, I definitely write down the right numbers. Oil volatility is at 118 this morning. For those of you that don't know what that is, again, I don't have time this morning to educate you on everything that you didn't spend the time on. I just can tell you that that's a shitload of volatility, okay? That's well beyond any level of volatility that the oil market's seen during most crashes that it's had. So again, we're starting to redefine what is the interconnectedness of volatility. So again, when you take some place, just like any other place in nature, and you shock and awe it with thunder and lightning, again, you as a human being don't have any way or any capacity to control that. There is no catalyst. Only on Wall Street somebody might say, well, if you look at the valuation's not going to stop that. You need to change the prevailing conditions of growth and inflation slowing, and the Federal Reserve, just FYI, can't do that. So again, important to be watching here this morning. A lot of people are incidentally surprised that the Fed looks impotent. They certainly looked impotent when I was making the exact same call in March of 2008. 10-year yield, already talked about that. So again, for those of you that don't know how to do this, I'll just give you a quick one. So 10-year yield, same thing. We have a risk range, right? So I have 0.57% and I have 1.18, okay? So at 1.18, that's where I'd buy some treasuries if I'm actively trading treasuries. I'm not totally sure that I'm willing to do that right now. Again, because I again told you to book gains when you get where? You sell bonds when the treasury yield gets to the low end of the range. It was actually lower than that. So the problem with this is that this is a higher low versus where it was on the lows, like below 50 basis points. That's where the bond market fully priced in that the stock market didn't quite get it, and neither did credit. Okay, so that's how you do it. You sell bonds here, you buy bonds here? No, the other way around, because this is the yield, this is not the bond. So again, you sell bonds here, you buy bonds there if you're actively trading your position. What I'm trying to tell you, obviously told you this on Friday as well, is I'd already be taking down the gross position there. It's been the biggest position that we've had. Now it's going to be a lot smaller for me this morning. You know, with it down 20 basis points here on the open, Jonesy, the 10-year yield, it's a gift to take down your risk there. You could be doing it all day back towards 0.57%. And what it really does is remind you of the fulcrum point in times like this when gold and treasuries are picking up equity-like volatility. It's that cash is king. All right, so raising cash, never have had a problem with that. Obviously don't have a problem with doing that or telling you to do that this morning as well. But guess what? That's not a new concept for people on the U.S. stock market open today. So maybe a good spot. Oh, by the way, just to give people what we also give you, and apologies for going a couple minutes over. Usually I do this in 12 or 13 minutes. Some people are like, well, you talk fast. Well, I got a lot of shit to get through, okay? Our daily data dump from Darius Dale, who's my partner in crime here when it comes to measuring and mapping the rate of change. The color code is red if the rate of change slowed. Chinese data, obviously horrendous last night relative to these, I don't even know where people come up with these expectations, but the expectations were obviously out to lunch. And a good spot to take some questions.
All right. First question's from a guy who has done fairly well through this collapse and is looking at potentially donating some money to inner city schools, which will definitely need it. But his question is, guys, do I close my TLT today? And we've talked about this a little bit, but a lot of questions about this. Do I close my TLT today or wait till they shutter markets? Trying to give all my Hedgeye profits to inner city schools to make you New Haven Canucks proud.
That's awesome. Thank you. Thank you for doing that. I mean, it's we absolutely need leaders to step up in the community. And if you did make a lot of money, it sounds like in treasuries, then I'm certainly sure that those kids would appreciate the help. We're a big, actually, we're the largest contributor to the Bridgeport Caribe Youth League in Bridgeport, and we'll absolutely be helping. So again, thanks for saying that. Actually, did that question get a lot of votes? Or that statement? Because I appreciate that. There have been so many times in the queue, even our own paying subscribers, they might be trite or a little snarky. I can be right back. But days like today, that's a super important point. Thank you. I would never just book an entire position. I mean, that's me though, right? Again, what you need to do is establish, before you even listen to anyone, including me obviously, is what is your max position by asset class? So again, we've talked a lot about that at Hedgeye. Max in a fixed income position is 10% of my assets. But if I have 4 different fixed income positions, that could be 40, 50% of my assets if I have 5, 10, or 5 or 6 positions rather. So something that like TLTs coming into this in January, I was at max. 10%, then it went to 11% because it went up, it appreciated. Sell some. Every time it's at the top end of the range, sell some. So you'd already been taking down the gross exposure to the position. That's the whole point of the risk range process, is to not be a pig, okay? And then, now let's say we got the position down to 5%. instead of 10, which is our max in TLT. What I'm saying today is I take that, cut it in half again, maybe towards 2.5%. But I wouldn't sell the whole thing. Why? Because at 57 basis points, I might sell another half of that. So again, that's another way to think about taking down your gross position, but understanding where your max is. And again, if we get to 118 on the 10-year yield and I got it down to 2%, then I buy 100 basis points worth of treasuries. Now I'm at 3% position. So that's how I would never take the whole thing out unless it's something that I want to short. In this case, I have plenty of things I want to short, financials, technology stocks in particular.
Okay. The most highly upvoted question is about gold. I think we've sort of touched on gold enough, so I'm going to
I think we have.
skip that one. But
well, there's a panic there, just to be clear, because our subscribers have been long gold. And anytime I reverse course, like when I went from long German stocks to short German stocks, long Russian stocks to short Russian stocks, I was long oil and commodities in January. And then we not only sold them, but we shorted them. So again, I'm not shorting gold. I'm just telling you that I got out of a big chunk of it late last week, and I would not be buying it here, certainly not with gold volatility at these levels. There's no other way to answer the question. I'm not here to babysit you, right? I'm not here to be your emotional support. I'm just telling you that I have a rules-based system that is actually quite unemotional and apolitical, and in some cases it sounds insensitive.
Okay, so the number 2 question with 59 upvotes, what would your core holdings be right now?
Cash is number 1. I mean, I'd say Hedgeye is my number 1 holding. I mean, then I got Hedgeye, then I got cash would move to number 1. And again, I'm not even totally convinced on that because the volatility signal on the US dollar isn't exactly easy. Last week, though, a big move in the dollar. The dollar was up 2.9% on the week. You had other currencies like the Australian dollar. They devalued it, and it was down 6.5% against the dollar. You had the Norwegians cut interest rates. Their currency was down over 7% last week. So there's a lot going on in the currency market. But again, having cash is probably the most sensible thing. With the alternatives are buying things with rising volatility like treasuries and oil, or treasuries and gold for that matter. And I've already told you what I think about that.
Thank God you guys are back. One more day of Muhammad El-Arian pronouncing R's as W's might make you jump out a window. Would you expect Quad 4 equities to be the quickest sectors to bounce when and if the VIX gets back to investable levels?
Well, if I look at the equity premiums associated with,
Like you know when those guys like El-Arian talks, he actually says absolutely nothing, and it takes forever to get it out of his mouth. I mean, that's just not what we're doing here, right? I'll tell when we get long any kind of an equity, including the Quad 4 longs that we would be long, but I'm not currently grossed up in, which would include utilities at the top of that list. Again, we'll tell you. There's no wow. It's just like buy the thing, right? That's what we do. We send you a real-time alert. That's what it says. It says buy it. And then I'll say it on the morning show, and I'll also write it in the early look. So the way that my work process works, God forbid that I actually executed on what people thought. Some people thought that Hedgeye was like whatever they hoped it was. Isn't it you get that feeling when you hate somebody because you're hoping they're somebody that they need to be so that you keep winning? I just never quite turned out to be that thing, and this place didn't either. All Hedgeye actually ever wanted to be was a hedge fund you could look inside and see with 100% transparency all that they do. What is their process? Like, guy gets up at 4:30 in the morning, he's a little batshit crazy. Well, I got to do that because I'm not as smart as everybody else. I have to execute on this process. Then at 6 in the morning, I give you the top 3 things in the risk ranges. Then at 7:30 in the morning, you get the early look. And then at 9 in the morning, you get the macro show. And now you're going to actually be able to watch our morning meeting. It's called The Call. We've actually given that to all of you for free. We've been beta testing it and piloting it. So we're going to just show you everything that we do throughout the day. Why? Because we're comfortable with that. We're comfortable with I don't like making mistakes, but I'm comfortable making mistakes. You ever play a sport, you're going to make tons of mistakes. The only people that don't make mistakes are people that cheat on their handicap or whatever else. But you don't believe them, do you? So again, we're just going to show you all the moving parts of what we do. I submit that it's better than the alternative. It's certainly not a newsletter. It's a process. Okay. So when we go bullish on something like that, I'm not going to just try to sound smart or anything. I'm just going to tell you to buy it.
Hey guys, thanks for the show. With such huge volatility occurring after market hours, how are you risk controlling the overnight moves when, for example, you might have a profitable short at a close, but a protective stop can't get executed if the market goes limit up the next day, or vice versa? I guess the first point is not an environment to be taking a lot of risk at all. Grosses should be low.
Yeah, and I don't use, on the short side in a bear market, I don't use limits. No, that's not how I trade. I know some people think that they're the greatest traders on earth and I suck at trading. I mean, whatever, you can think whatever you want. I mean, you book gains on shorts that you shorted on Friday into the close. You could do that on the open today. We've got a lot of quick moves I make in real-time alerts, more so to actually let you know what I'm thinking in real time. I think that's an important thing to do as opposed to just talk. I do a lot of talking on this show because I get, what if I didn't talk? I mean, so your alternative is listening to somebody who's talking about nothing, or listen to me try to explain what I'm doing, and then show you what I'm doing with no words verbally coming out of my mouth in these real-time alerts throughout the day.
Hi, Daryl and Keith. This is from Hannah in Canada. What are your thoughts on Canada? Is it a mirror of the U.S. model in terms of the Quad 4 portfolio?
Well, slide 20, one more time, we go to the G20. Again, nothing's a mirror of anything. So we don't want to reduce ourselves to making generalizations like the old wall does. That is a human nature. It's Occam's razor. People are looking for shortcuts. I don't do shortcuts. I do specificity. So on Canada, thank you, Ed, for asking the question. That's where I was born and raised. Canada was a very bad place to have your money in 2018. Yellows and reds are bad, by the way. Currently, coming out of 2019, Canada got really bad again. This one is going to turn into a red 4. So that's Canada. That's what Canada looks like specifically within the lens of the quads. Now, again, we A/B test everything that we do. 50 different countries. That's just the top 20. Obviously, the G20 guys. You can throw up the slide where we show the rest of the countries we do. We know where the quad is. It's a mathematical fact, and then we have the signal. So it's called an A/B test. So I take all those countries. That's a lot of data, right? How many data points? We're talking 1,200 data points. Before I actually talk, before I talk, I know that. Right? There's a big difference. Is somebody speaking in this case at you mathematically or not? We are, okay? So where's the country in this case? What quad is it in? And B, that's part A of the test. B is what is the market signal? The market signal on Canada, which is a price volume volatility signal, is horrendous. It's not the mirror of horrendous, but it's horrendous. It's bad. It's trend and tail risk bearish.
Okay. Let's see here. We have a lot of questions. Apologies.
I like how you gave preference to the Canadians.
Yeah.
Isn't Jonesy looking all Peaky Blinders this morning?
All right, so we've talked about this a bit, both online and offline. But again, it comes to the point of not having a lot of risk right now. But could the U.S. markets be closed down for a while? Thinking of lowering my position size when following real-time alerts. Practically speaking, I think we're in a place where anything could happen right now. So,
what you don't want to do is you don't want to lose your shorts. Okay, so in addition to shorting tech and financials, which I showed you, again, look at how much they were up on Friday. That was a bloody gift. I don't know, and I say this all the time, I don't know how many more of these, and these are largely a function of the bubble that we were in. Don't forget, a lot of people own stocks, right? It's like you don't know what the fuck you're doing. So at the end of the day, you're in this position. Shorting equities is easy. Staying with your credit shorts, now that is something that needs more patience because they're not going to let you borrow it or trade around it as of probably now. So again, stuff like bank loans, levered loans, junk bonds, J&K, stuff like that. So again, the shorts are easy to stay with. The longs is totally up to you. Again, shutting down the U.S. stock market is the dumbest idea since the last idea, which was for the Fed to panic on a Sunday night before the U.S. equity futures opened, which was the dumbest idea up to that point prior to the prior one, which is the Fed cutting interest rates by 50 basis points after the prior market update. I don't know what this rookie's doing. Really, I would love to have a little quick conversation with P.E. Powell. If you don't know why we call him P.E. Powell, it's private equity Powell. He worked at Carlyle. I did too. He made tons of money. I think you should just go back there. You are not made for being on the switch at this point, buddy. And this is not going well for you. So maybe instead of talking about shutting down the stock market, somebody should go get him out of his seat.
Do you expect credit spreads to continue to widen?
Absolutely, and that's what people thought that P.E. Powell, don't forget, he's got to protect the house. Do you wonder where he came from? How did this guy just kind of come out of nowhere? He didn't come out of absolutely nowhere, but he wasn't like an ideologue, again, big-time academic, massively huge brain like Bernanke. Yellen was a beautifully smart woman as well, but he was a lawyer, right? He's a rich lawyer from the Carlyle Group. Well, why did he get that seat? Well, because all of private equity understands that they need somebody to protect the house if credit spreads widen. You know how much the leverage, when people say all the imbalances, there's no imbalances because I missed the last two crashes, I can't see those anymore. There must be no imbalances. No, all the leverage went from the banks to the buy side. What's private equity? That's the buy side. Credit, it's the biggest corporate credit bubble in U.S. history. What could possibly go wrong? Guys, go to slide 90 in the current macro deck. Let's just do a little tutorial on that. We might go overboard here a little bit today in terms of time. But again, provided that you don't know these things, I would submit that you should. If you look at where we're at, like that's domestic corporate credit as a percentage of GDP. Never been higher. What could possibly go wrong? And by the way, what happens when these things enter a recession? So if your view is that we're in a recession or not, I don't particularly think you need one. Look what happens here. Oh boy, that's actually what happens to credit. It kind of goes away. So this point in time when the credit as a percentage of GDP runs into this thing, which is called a recession. These are the recessions. Okay, what happens? It peaks down, peaks down, peaks from the highest level ever. Where's it going to go up? All right. Credit spreads, by the way, next slide's an interesting one for those people that don't know. By the way, if you look at slide 92, that's actually those two slides together. Go to 91 back again. So triple Bs as a share of the U.S. investment grade market have never been higher. Credit spreads prior to this move, which is what's just happened, is that instead of 300 over, it's going to be 800 over today. And then on slide 92, what the street really got long, and this is what I try to remind them back in November. Again, and I do think that people have to have some responsibility associated with buying stocks because the President of the United States going all caps on you. They were expecting the ISM to bounce. Now it's going to crash. So what happens when the ISM goes to lower lows? This is the ISM. This is the oh. Thank you. ISM is the black line. Oh, it bounced. The bottom's in. According to who? Holy moly, Mike Santoli? I mean, no, that's what happened. The trend in the ISM is this way. That's called a head fake. Now that sucker's going off the chart. What happens when that goes off the chart? The inverse, which is high yield spreads, credit collapses. This is the easiest. As I was saying, it's not the call that we've been making this week or the call we made last week or the call we made the week after that. Yeah, there's a lot of plays within the play that I have to call. I don't know why, I don't know why I'm the one who has to do it, but the reality is that seeing this coming was very obvious. There's only 3 times in my career in the last, really going back 20 years, where you had a full and proper credit cycle, employment cycle, profit cycle peak. All 3 of those, they sleep together, all right? This isn't your typical kind of relationship that you think about in terms of like mom and dad. This is, or whoever and whoever. I don't care, right? Obviously, I don't care about a lot of the things that I say, but this you should care about. It's called the full employment cycle, full investing cycle, as we like to say it. So for credit to collapse from here happens 100% of the time. All the virus did was it made it happen faster. And that's the most important point. It's very similar to post 9/11. The economy had already been slowing. And by the way, I didn't miss that move either. The economy had already been slowing. You get a shock, it just makes it slow faster. So when people say, well, this is just the virus, that's complete bullshit. That completely ignores everything that they've been ignorant of prior, which is where are we in the long-term cycle now that we had a cyclical shock.
Okay.
Maybe one more?
One more. Let's see.
Selfishly, I have to trade.
Okay. Why is the TLT up $6 while bonds in general are down, like AGG and BND? And AGG actually mirrors the Barclays broad bond index.
I don't want to get into the construction of old wall shit, right?
Yeah. That's the problem.
I didn't make these things up. I didn't make up their ETFs. TLT is a pure play on treasuries. That's why it's doing what it's doing. AGG, yeah, you and me, or whatever other thing that the Wall Street created for you, tell them to explain to you what's going on in those things. I have no idea. Like if I go in and dissect them all, I'm just trying to truncate a question. We could obviously spend an hour or a whole seminar on teaching you on poor construction of ETFs, and what you thought was in something isn't quite that something. So again, that's probably what's going on in some of those things.
Yep. Okay, we're going to wrap it up there. Back at it tomorrow morning at 9 a.m. and obviously on Twitter. We'll be sort of following all the action today. Anyway, thanks for tuning in today. Back at it tomorrow. Thanks.